Welcome to Caterpillar's 2013 year-end and fourth quarter financial results recap. I'm Jim Dugan, and I'm joined once again by Brad Halverson, Caterpillar's Chief Financial Officer. Brad, thanks for joining us again today.
Yeah, thanks, Jim. It's a pleasure to be here. You know, we posted a solid fourth quarter, and our full-year results exceeded our outlook. Let's look at some of the numbers. For the fourth quarter, our sales and revenues were $14.4 billion, down 10% from the fourth quarter of 2012. Fourth quarter profit per share was $1.54. That's up from $1.04 in the fourth quarter of 12. Now, in the fourth quarter of 2012, we had a couple of unique items with a Seaway impairment and a positive tax settlement. If we adjust for those items, 2012 profit per share in the fourth quarter would have been $1.46. Now, that's relevant because if you look at this, Jim, our sales were $1.7 billion lower this year than they were last year, and we had higher profit per share. Great performance.
So clearly ending the year on a strong note in the fourth quarter, but all in, also a very difficult year for Caterpillar overall from where we started a year ago or so. And let's talk a little bit about that, driven by mining mostly.
Yeah, our 2013, if you look at the full year, our sales and revenues were $55.7 billion, down 16% from 2012, and our 2013 profit per share was $5.75, down from $8.48 in 2012, but ahead of our outlook that we published at $5.50.
And again, that's really driven quite a bit by resource industries, primarily mining, and something we've talked about over the last year, but maybe we can go a little bit behind the numbers and talk a little bit more about what happened, particularly in the mining area.
No, you're right, Jim. You know, sales were down $10 billion, but the real story was in resource industries. This segment has been traditionally our most profitable and largest segment, and their sales were down $8 billion. That's close to 40%. So you might say, what happened? Well, when we started the year, we thought commodity prices would hold up, and they did. We thought mine production across the mining companies would be flat to up, and in fact, mine production was up. And we thought that had to lead to an improved order rate for us, and the fact is it did not lead to an improved order rate, and we consistently took our mining forecast down in terms of sales for the year. But I think the important thing is the resource industry group, and we knew there was risk if the orders didn't materialize. And in fact, we started taking action in the first quarter of 2013. And because of that action, across the board, we were able to deliver these results this year.
And one of the benefits, if you will, and one of the things we can talk about next, I think, will be those strong operational results. And so let's talk a little bit about that, again, in the context of a difficult year in 2013.
Yeah, it's a tough year when you have your sales go down $10 billion. You know, we've talked externally about the fact we'd like to limit our profit, kind of our operating profit decrease to 25 to 30% of sales on the way down. And we finished the year at 29%. Now, the fact is it was difficult this year. 2013, when we talked about this 25 to 30% commitment, we didn't anticipate that 80% or $8 billion of that sales drop would be in our most profitable segment. So that was a big headwind, about $750 million headwind for us, Jim. And again, we really focused on cost. Cost reduction activities across the board, across our types of cost. And this year, if you kind of exclude cost absorption, we had a cost reduction of $1.2 billion. You know, in my career, this has got to be the biggest number, and I would say a big thanks to the employees. The employees that are out there listening to this, a tremendous amount of sacrifice, rolling layoffs, shutdowns, impact on families. But together we were able to pull through and meet our commitments on profit pull-through. But the fact is the quality work was great. Our business model's working. We improved our market share. Our quality is improving, all-time record quality. You get out and see a customer and you hear that. And our safety improved. We're getting our employees home safer this year than we did last year. So I'd say it was a very solid year.
So good marks on quality and safety, very important things. Another thing in the headline that we don't want to miss out on and we want to talk about, all-time record for operating cash flow, a very positive story there as well, Brad.
Yeah, an outstanding year for cash. And when you look to a company's health, you really want to look to the balance sheet, and we continue to strengthen our balance sheet this year. $9 billion of M&PS operating cash flow. That's $1 billion higher than our previous record. And let's just take a second to talk about our cash deployment opportunities. What is operating cash? You know, in its simplest terms, it's the cash we have left after our operating expenses. And that as a company, you look to how you want to invest that. Our first priority is to maintain the strength of our balance sheet. And our debt-to-cap ratio is a good measure for that. In the last trough, we were at 58%, and we finished 2013 at below 30, 29.7%. The second thing is to fund growth, you know, and this is very important for our employees. You know, we need to invest in the long-term health of this business, invest in products, solutions, things that make our customers more productive and able to win their business. In 2010 through 12, with some of our acquisitions, we spent $8 billion a year during that time frame. And in 2013 is a more normal year, and we spent $4 billion on growth. We want to maintain our pension funds to be well funded. 61% again in the last trough. And we finished the year in 2013 at 86%. And this is in a low interest rate environment. You know, if we could get a 1% increase in long-term rates over the next few years, that number would move to over 95%. So our pension pension plans are well funded. And then when you look to shareholders, they expect a consistent, sustainable increase in the dividend. We had a 15% increase this year. And then the last one is to look at stock repurchase. In 2010 through 12, we didn't have any stock repurchase, no return in this area to our shareholders. But we've built up the strength of the balance sheet, and we have the cash available, and it's a good thing to return it to the people that own our company. And in 2013, we had a stock repurchase of $2 billion, and we announced our expectation in the first quarter of 2014 to repurchase $1.7 billion. And with that, the board authorized a new $10 billion authorization for stock repurchases spanning the next 5 years.
So wrapping up that story on cash, I'd like to move next to our outlook for 2014. And there are a lot of variables that always go into this, and certainly that's the case for 2014.
Yeah, we expect sales and revenues in 2014 to be similar to 2013. That is about $56 billion in a range of plus or minus 5%. World economic growth is improving, confidence is improving. We have a world GDP estimate of around 3%, but I can tell you, Jim, we remain very cautious as we move forward. In terms of our profit outlook, we expect restructuring costs in the neighborhood of $400 to $500 million, and our profit outlook is $5.85 per share, excluding these costs. Considering the restructuring cost, our profit outlook for 2014 is $5.30 per share.
Well, Brad, we've covered a lot of territory so far, but we're missing a few things that I think we need to hit on before we wrap up, and really the other important segments that are part of the Caterpillar story. So let's touch on that before we finish up today.
Yeah, if you look at 2014, let's start with Power Systems. We're forecasting a 5% improvement in sales in our Power System business at the midpoint. It's our largest, most profitable segment now. It's very diverse. And I'd like to show a chart here. Let's just take a look at the history of this group and how they performed. 2010 to 2013. Our operating profit percent is improving every year. They've done that across a variety of different sales levels. The bottom line, this is a very consistent, outstanding performing group for us, and it's been that way for a number of years. Construction Industries, again, we think they'll be helped by the world growth that we're forecasting. We have them up 5%. Their inventory is at normal levels at this time of the year. They had a really good fourth quarter. Their operating margin was 10%. That's up significantly from previous quarters. They have some good momentum behind us. And then we have Resource Industries. You know, Jim, again, this is a great business for us. I'll say it again, we expect commodity prices to hold. We do expect production to be flat to up, but the miners are very cautious on CapEx. We're going to forecast a 10% decrease and remain very cautious in this business in the short term, but very bullish for it in the long term.
A lot that we've covered so far. Any final thoughts from your perspective before we wrap up then?
No, we're into 14. We're looking forward to 14. In closing, I would like to thank our customers. They make our work possible. And I'd also like to thank our employees, dealers, and suppliers for their hard work in making 2013 a successful year in very difficult times. And we're all going to pull together and have a great 14.
All right, thanks very much, Brad. A great update. And thank you for joining us on this 2013 fourth quarter and year-end results recap. We'll see you next quarter.